Westwood, a Dallas-based investment management boutique, recently acquired the asset management business of Salient Partners, a Houston-based asset management firm. Westwood has also recently acquired a majority stake in Broadmark Asset Management, a San Francisco-based asset manager offering hedged equity strategies and that serves as a sub-advisor to a pair of seasoned mutual funds and separately managed accounts now offered by Westwood. Joining me today to discuss the synergies derived from the acquisition are Adrian Helfert, Chief Investment Officer of Multi-Asset Portfolios at Westwood, Reid, President of Real Assets at Westwood Salient, and Cortez, Co-CEO of Broadmark Asset Management. Gentlemen, thank you for joining us today.
Thank you.
Thank you.
Thank you.
Adrian, it's a pleasure to have you back in the studio. Let's start with you because you're the veteran here. The acquisition of Salient puts Westwood in a truly unique position. Why Salient, and what does this mean for Westwood and its clients?
Sure, thanks for the question. We are really excited about what we've achieved here in bringing two great firms together that have a similar ideology around how we think about investing, have complementary products, and have the ability to improve our outcome for existing investors. On the Salient side, they bring in energy, real estate, tactical allocation. My colleagues here, Reid, talking about real assets, real estate, energy, will be extraordinarily helpful in bringing in extra insight for what we're doing on multi-asset. Same goes for Cortez, talking about Broadmark Asset Management, thinking about tactical allocation with their tactical growth product. On the multi-asset sphere as a whole, we're of course providing solutions for clients that help them meet an objective. And the better insight, the more insight that we have from experienced investors in very targeted spaces is better for our client base. In addition, just having those siloed products of offering an energy solution, offering a real estate solution, a real asset solution, and infrastructure is something we can now do for our client base and show them how we've had good performance across value equity, across multi-asset in the past, and showing that we think similarly in bottom-up analysis and finding good opportunities in high conviction strategies and producing that for clients. We're able to offer that to our client base now, and the same goes with Broadmark Asset Management and showing tactical asset allocation on their tactical growth product, of being able to produce good solutions for clients, so things that fit a particular need. That's what we're trying to build, is stuff that we think will help our client base. And the way we think is very similar and very complementary as far as bringing together the idea around deeper discussion in siloed asset spaces, of good fundamental bottom-up investing, and good thoughts around asset allocation of the ways and means of the world and how we can produce a good outcome for our clients.
Adrian, since we're discussing products, tell me a little bit more about the multi-asset franchise at Westwood.
Appreciated. Our flagship product on the multi-asset side is a strategic product called Income Opportunity, where we're investing in a plethora of products that are non-standard products. Think MLPs, real estate investment trust, REITs, convertible bonds, preferreds, obviously equities and bonds, and we're using a distinctive style to achieve a good outcome for investors, using our biases, our deep thoughts around fundamental investing, which is decorrelating for investors by just basic finance theory. This is good. We're finding individual opportunities that we think are underappreciated and investing in those and deploying it into a method that helps clients broadly. Expand that out broadly for the multi-asset strategy in the platform. We've got strategies that range from higher income products or very income-oriented products with lower risk-on kind of behavior, to the Income Opportunity Flagship Fund, to an alternative implementation that was down just over 1% last year when equity markets had a really difficult year. So keeping clients very safe in times of stress, where at the same time we're also investing in systematic strategies and showing things like growth opportunities. And then of course we get excited about when we talk about bringing on board energy and tactical allocation products as well as real estate.
Greg, let's talk about energy for a second. These assets languished for a long time, but you and your team still managed to produce 10% compound return for 16 years compared to only about a 7% for the Illyrian MLP index. What do you see for the industry moving forward, and how is your strategy positioned to capitalize on that?
That's correct. So you touched on the longer term record is excellent at 10% return. We started off in 2007 and enjoyed about a 10-year period of good returns, and then, as all of us know, COVID was a very negative experience for the industry. We saw crude oil go negative briefly in March of 2020, And that really set up what we think is a sustained period of outperformance. And by that I mean energy strategies had a period of underinvestment going back to around 2017 through today. And that leads to higher than normal returns because of lack of capital investment, lack of competition, and we're enjoying increased flows from the pipelines themselves in oil and gas. So in terms of how we're positioned today, we're in an asset class that has about a 5.5% yield. We're seeing dividend growth in the companies of 5 to 7%. And that really drives the total return that we expect to see in the market. In addition, about 80% of the companies are buying back shares actively, which is a huge number, and that accounts for about 1 to 2% reduction in their float. So the combination of those three things, the dividend yield, the dividend growth, and the share buybacks, gives you a very attractive expected return. And then valuations will change. Last year, we actually made about 24%, while valuations got 7% worse, which is amazing. Valuations contracted, and we still made positive returns because the EBITDA growth was in the low double-digit territory. So for this year, we're expecting EBITDA growth of 5 to 7%. That's what's driving the dividend growth. And so we think we're in an ideal spot with continued underinvestment in the energy industry traditionally. More money is going to clean energy today, which we're also focused on, but the traditional energy has a very favorable outlook again this year like it did for last year.
Rick, as part of the overall deal, Westwood acquired a significant majority stake in Broadmark, some of which was previously owned by Salient. Broadmark's strategy is especially compelling as it literally sidestepped losses that many investors experienced during the dot-com bubble, the Great Recession, and more recently, the COVID-19 pandemic. Over the last 2 decades, you've only had a max drawdown of about 8.41% over those 2 decades, and you've actually achieved positive returns during the dot-com bubble and the 2008-2009 financial crisis. How does Broadmark fit into the picture at Westwood, and how are you able to weather those rough patches?
Well, we're a pretty unique manager. We have a very different investment strategy, and I think that we complement what Westwood does already. You know, most equity managers, in fact 90% or more of equity managers are long only, and in many cases equity manager mutual funds are fully invested at all times, have to be fully invested at all times by prospectus. So most of them are long only, and even in the long short space, most long short managers are long biased, which means they're never going to go net short, or very rarely are they going to get net short. We're the opposite. Our goal is to make money every year. We've done so in 17 of the last 21 years. We're an absolute return manager, and therefore we don't have to be long all the time. There are times to be fully invested, and in our opinion there are times to be very, very cautious, and we can reduce our invested position to 0, so we can be 100% in cash, and we can also take short positions in the market. We use ETFs because liquidity is very important to us. If something terrible were to happen in the world, we need to take our portfolio, move it to cash immediately. So we only invest in ETFs, and some clients allow us to do futures in major market indexes. So I think we can be very helpful to Adrian's macro view as CIO. And in addition, with a smaller amount of our portfolio, we look at industry groups, sectors, styles, value, growth, energy, and I'm hopeful that we can be helpful to Greg, and Greg and I have worked to get each other for years, on our work on energy, on financials, on healthcare. So we're able to hopefully help Westwood in terms of the macro view as well as the micro view.
Thanks, Rick. And let's dig into Broadmark a little bit more. Could you explain Broadmark's role and approach?
Sure. We have 3 guiding principles. Don't fight the Fed, don't fight the tape, and beware of the crowd at extremes. And we take these principles and we put them into a process, an investment process. We call it the 4-pillar process. The first 3 pillars are valuation, monetary policy, and credit conditions, and investor sentiment. And these are fundamentals. The problem with the fundamentals is that the fundamentals can be great and the market can collapse. The market doesn't listen sometimes to the fundamentals. It does its own thing. For instance, I'll give you an example. In 2008, valuations were the lowest in a decade. The Fed was starting QE, and people were panicking, right? This is the perfect stock market bottom. And yet the market went down 30% again into 2009 until the March 9th, 2009 bottom. How do you guard against investing too early because the fundamentals have gone well? Our answer is the fourth pillar of our process, which is momentum. And by momentum, I mean the flow of funds into and out of the market is measured by up and down volume and breadth, that advancing and decline issues. Only when momentum changes do we follow the fundamentals. So the momentum indicators for us act as a check or a regulator on the fundamentals. So it allows us not to try to catch a falling knife, but rather to wait until all of our models are in sync, and that's when we invest. And you might say, well, yeah, Rick, but you're going to be late because you're waiting for all these things. But in 2009, yes, we were late. We got in March. We were fully invested by April, but we had a return that was just about the same as the S&P 500, up well over 20%. And in 2000 and during the dot-com bubble, when we got invested, we tilted the portfolio towards small caps, and we were up far more than the S&P 500. So what we try to do is establish the exposure of the portfolio and then select, construct the portfolio for those indices which are showing the most relative strength. So that's our investment process.
As we start the new year, let's talk about recessions, and it's become known as the most anticipated recession in history. What are some of the indicators that you're watching out for, and how will the Fed impact those conditions?
Well, to us, the most important drivers of stock prices are earnings, of course, valuation, but of financial assets, the most important thing is monetary policy and credit. So I'll pick two indicators, and you guys might want to do other ones, but my two are the yield curve. The yield curve is negative, is inverted. For 70 years, it's got almost a flawless record of predicting recessions. The timing is iffy. During the pandemic 3 years ago, the yield curve inverted right as the recession was happening. It was over in a minute, or a few months. In the 1950s and the 1960s, often it was 6 months early, 1 year, 2 years early. So the timing is not always exact, but the yield curve inversion means there's going to be a recession at some point. At least that's what we think. The second indicator I'd point to is credit spreads. Prior to recessions, credit spreads usually widen because there's a scramble for money. Companies can't finance their inventories. They've got unsold goods, or lesser credits see their business go down and they have to scramble to borrow in the short-term markets, and credit spreads widen. And by credit spreads, I mean the 10-year versus high yield. That has not happened. So while we believe that recession's on the horizon sometime, we don't see an indication of that yet. So those are the two I'd look to, and if credit spreads start to widen, I think we all better get a little bit more worried about the market.
Greg, would you like to add to that?
No, like you said, I think this is probably the most widely anticipated recession, which means part of it's priced in already. I'm in the energy business, so we look heavily at credit spreads, as Rick elaborated on. We also look at commodity prices, and typically what you'd expect is the market is building in today crude oil prices that are lower in 12 months than they are today, so the curve is backwardated, and the market's already building that in. So to some extent, people expect a recession. The question is how long, when will it start? Will we actually have a recession is probably a fair question. So in our world, what we've studied is there are really two types of recessions. Those that are shallower tend to have very little impact on crude oil demand, and that's the most important thing in our space for energy infrastructure. If the world uses more crude oil, there's a need for more growth, and our businesses will benefit because of volume growth. The second kind of recession is the COVID recession or financial crisis, which is a worldwide drop in demand. That's negative for our business. It doesn't look like that's going to happen this year. It doesn't look like it's as serious as COVID or the financial crisis. So a shallow recession, one in which China's still growing, which looks to be the case this year, is really not a big deal for our business. It's a shallow recession in the US and Europe, and probably doesn't really impact crude oil demand, and therefore our volumes keep on growing, which means we make more EBITDA this year. So not terribly important in our outlook for this year.
Adrian, you want to add any indicators you're watching?
Sure. Well, these guys called it out well. One of the biggest prognostication factors is that 10-year yield less the 2-year yield. Right now, we see the 10-year government bond yield that is less than a 2-year yield. You get no premium there, it's a negative premium, and it's telling us that future growth is going to be lower. That is, for the past 70 years, that's had a really good track record of telling us that a recession is coming. Another one that we look at was out earlier, just very recently, a couple days ago, is the Conference Board leading indicators. When those go significantly below about 100, we see a recession, and that's also been like the 10-2 curve. It's very good at predicting a forward recession. That's where we are right now. Now, just belabor, so we have all these indicators that are telling us it is likely, it is coming. It is, of course, very well telegraphed. There's all the stuff that is the intangibles, like the Fed. What's the Fed going to do? And that's why we're predicting recession. Is the Fed going to keep rates extraordinarily high to combat inflation? Is inflation going to come down enough for the Fed to stop quickly and then subsequently drop? If the Fed were to say tomorrow, or at its next policy meeting in February, if the Fed were to say, you know what, we're going to actually cut rates. This is not going to happen. Right. If the Fed were going to say, we're going to cut rates, then immediately the market would say there's not going to be a recession. So what the Fed does is going to drive whether we see a recession or not. I, like Greg, believe it will be a shallow-oriented recession if we see one. So really the R word just says lower growth. And it's going to be a shallower recession because the consumer has come into a much better spot. This time around, we see less potential for a leveraged unwind. We see better balances as far as corporates that have funded their liabilities out further. So we see less chance for a leverage unwind, which often happens in a big way. We just see a longer potential for lower growth.
Obviously, the Fed is a critical link here. What do you think the Fed is watching most closely right now?
Labor. That is one of the biggest things that they are watching right now. And they're telling us this actively. They've come out and said, we need jobs to be lost. We need unemployment to rise because wage inflation that is rising more significantly than goods inflation means goods inflation is going to continue to rise itself, and goods inflation is above where the Fed is looking. There are other indicators, but they're actively telling us that inflation is driven by wage inflation that is remaining elevated because there is an overheated jobs market. This is not a financial bubble that they see. This is an overheated labor market driving goods inflation. There are supply chain issues, and there are other things that the Fed really can't deal that much with, a very blunt tool of interest rate policy. But they can slow the economy, and the economy means jobs lost.
I would just add that 2 points. One, that credit spreads back up a shallow recession. We don't see the kind of credit crunch atmosphere that we've seen elsewhere. The other thing is everybody thinks the market's going down. Everybody thinks we're going to have a recession. So maybe it's shallow, and the real, I don't want to be too negative here, but maybe the real one is later, because that yield curve does have a pretty good record over 70 years of calling recessions. And recessions, market declines in a recession have averaged over 30% over the last 70 years. The last 2 recessions were 50%. So I think that we have more to go on the downside at some point, but I think that for the reasons that Greg and Adrian talked about, and credit spreads and the widely held belief that there's going to be a recession, maybe it's going to be different this time and it'll be extended out a little bit longer.
Greg, do you want to add anything on whether we'll have a recession this year or how deep it'll be?
Sure, we're expecting a recession like everybody else, I think, on the planet. So I'm just wondering, can everybody be right?
Yeah, right.
It's not my experience that all the Wall Street strategists and everybody can expect it and it's not already priced in. So I've become a little more optimistic this year that many people are calling for the S&P to fall, for example, to 3,000 or 3,200. It bottomed last year around 3,500. I'm in that camp that we might have a pullback, but it might be shallower than people expect because so much is already priced in. And there's a lot of money on the sidelines. There's a ton of money in T-bills just waiting for that buy opportunity. And it doesn't normally kind of get orchestrated where it all comes together and everybody just knows it's time to buy. So I'm a little more optimistic this year that a lot is priced in. And I think the yield curve being so inverted props up equity values. The 10-year dropped almost 75 basis points since last October. That's substantial. So that helps valuations for the market stay a little higher than maybe they otherwise would have been. But I still think there's some weakness that we're going to go through, and we're prepared for it. We're largely an investment grade, blue chip, midstream energy companies that have very high dividend coverage. I'm not that worried about dividend cuts or anything negative happening in our space. It's more just market volatility that we see happening.
Yeah, I would add that one way that we can be very helpful, I think, to Greg and Adrian and Westwood and the strategies is that at Broadmark, my partner Chris Gupsel and I have been in this business for 40 years plus. We've seen a lot of ups and downs during that period of time. We all have opinions about the market. We do not believe anybody has a crystal ball or anybody can predict. We don't predict. We adapt to the markets based upon our models. So I'm the first one to say here, I have no idea where the market is going. We let our models tell us right now. Credit spreads are indicating that there's nothing wrong yet. There's more shallow yet. But that's one way. It's a discipline and a risk management way that we can hopefully be helpful to others, including our colleagues at Westwood, to give them a different view from a more systematic or quantitative point of view of where the market is going without prediction. So.
Yeah, I'll add to that as well.
Yeah, please.
Of everything we're saying here is the market doesn't price the cash flows today, it prices the cash flows of the future. The market, just like Greg is talking about, we may already be valuing everything that is expected. We may already be looking through that to the possibility of revenue trajectories in the future. And I get excited hearing Rick talk about that because that is when we talk about how we think alike as investors, it is having a consistent and repeatable process that you can achieve a predictable outcome of outperformance for your investors is exactly how we all think. So consistency in our process is paramount to us achieving a good outcome for our clients and them having a predictable behavior for our strategies.
Adrian, you were able to beat your peers significantly every year for the last 4 years during both periods of risk on and risk off. And in 2022, a very difficult year for everyone, you beat 2/3 of your peers and beat a balanced benchmark style significantly. How did you do so well in both periods, and what are the benefits of using a multi-asset strategy in an uncertain environment like we have today?
Sure, 2022 was an extraordinarily difficult year in all asset classes. There was no place to hide. After this years of what was, there is no alternative but equities, all of a sudden there is no place to hide other than cash. And us having the ability to look across the capital structure, across the style spectrum, across the quality spectrum, in order to capture premium that shifts. I always think about it of squeezing the bubble, where does the air come out, which side does it come out? We can chase that. When companies start moving to a deleveraging mechanism from a capital allocation spectrum that produces future cash flows, then we may invest in the debt side simplistically as opposed to just the equity side. When we see changes in the supply chain that may mean commodity prices move a different direction, then we can invest in commodities. On currencies, we can look at what currency impacts happen and effectuate based on different central bank movements. So having that ability in a multi-asset strategy to quickly and efficiently be able to find value where, as I say, when you squeeze the bubble, where does the air come out? That is one of the key proponents of having a multi-asset strategy in one, of being able to chase the value where it occurs and having the expertise and the opportunity set sitting in front of you that you can do that efficiently and quickly is exactly what we aim to achieve with our process. As far as 2022 and those prior 4 years, we have been very tactical in our orientation. So this is not a straight balance strategy. This is the ability to operate outside the benchmark to operate to our client's best interest as far as chasing that value where it may exist. And then it fits with our thinking as well of a key piece of our multi-asset strategy is downside reduction. When we put on a fundamental viewpoint, it is looking at a 1 year, a 3 year, and a downside price target. What can go wrong, what can go bump in the night, as well as the upside potential. That is always there for us. And in doing so, that means on our strategies, we're looking to reduce that downside volatility. We don't want to be there when things go bump in the night. We want to achieve the upside risk. And so that's something we employ in all of our strategies in order to hopefully reduce that downside exposure. We have better upside than downside.
Could I add something to what Adrian said on?
Absolutely.
Adrian talked about risk reduction, and that's really important for us. I mentioned before that we're a little unique among managers. Most managers are long only or long bias, and they're looking to make a lot of money. We're about opposite. Our goal is reduce the risk, manage the risk. And one of our, I suppose maybe the fourth guiding principle is this statistic. If you never lose more than 10% over 10 years, 20 years, 30 years, 40 years, pick the time period, how much of the upside do you have to capture to beat the market? And the answer over all those time periods is about 1/3. So if you can contain your risk to 10%, never lose more than 10%, you only have to capture 1/3 of the upside to beat the market. That's us. And when the markets are going up and everybody's making a lot of money and we're up 3% or 4%, people say, what are you guys doing? Like last year, when the market really takes it on the chin and we're doing much better, they said, well, maybe that makes a little bit of sense. So I agree with Adrian. One of the things that the three of us have in common is risk reduction, is making sure that we have a disciplined process, that we know our risk, and we move to protect our portfolios very quickly if we see further downside.
I'm going to come back to Adrian here. Can you tell us why you believe that traditional pure investments may struggle in this new marketplace?
Sure. Pure investments, as far as siloed, if you have the difference between having strategies that have pure equity plus pure fixed income plus pure currencies, commodities, other, not necessarily that they struggle, but you can achieve a better outcome in a multi-asset strategy, not as a whole, but having a piece of that in order to allow a manager to efficiently operate across, as I say, the capital structure spectrum, the style spectrum. Otherwise, from a basic finance theory, we can reduce that correlation. We can take into account value migration across those pieces and very efficiently operate in order to have a decorrelated structure. A key part of that, of course, is we are using individual investments. We're a fundamental investor in our multi-asset strategies, and by nature, we are finding good opportunities that we feel are underappreciated by cash flows, revenue stream, outlook, what the CFO is telling us the future may lie, what a catalyst may be, and in doing so, that reduces our correlation to other assets that an investor may hold. So holding a strategy like that, where we have the capability of operating across different styles with fundamental investments, is absolutely rewarding for investors as a piece of their strategies.
Greg, you stress the importance of income from cash flows for this particular environment. Why?
Well, many investors are looking for income and have been for a decade. Our space naturally has a high dividend yield. We're around 5.5% to 6%. And so that's an attractive value proposition for investors to invest in MLPs and energy infrastructure. But I think above and beyond that, what really drives our returns today are the free cash flow the companies have. And so in the old period, going back a decade or so, the companies were investing a lot of CapEx for growth and basically overbuilding in some instances that created more capacity in pipelines that had to get corrected. And today, we're basically fully built out. There's not a need for a lot of CapEx, and therefore the companies can reinvest that money in dividends and share buybacks to pay money back to investors. So we think many investors underestimate how strong the free cash flow is in energy infrastructure and underestimate the return potential because they don't see that free cash flow as closely as we do.
Adrian, how is Westwood positioned for recession risk and this new normal of higher rates and slower growth?
Two big different questions. I'll start with the recession side, and we all have views, and we've talked about this significantly. You heard us talk about downside risk control. And with the strategies that we're offering investors, you've heard Greg and Rick and myself talk about that. We think that is a very good and rewarding opportunity for investors, and it goes with our Salient acquisition of we're pulling together strategies that have that ability, that have that characteristic that we think will reward investors should we see a large downside from a recessionary environment. How are we positioned? Within the multi-asset strategies, we're looking directly at sectors that will benefit. So there are some sectors on consumer non-discretionary sides that we think will be more defensive in characteristic. We're looking at certain areas like defense itself that we think will potentially benefit from some of the geopolitical characteristics that we see that are going to increase. At the same time, we think about the characteristics of a recession. You heard Greg talk about the depth of a recession, where we don't think it's going to be, we think it's going to be a shallower recession, and because of that we see elevated energy prices and we see value capture there because cash flow has been so strong, and there's a changing dynamic because they have been underperforming and under-allocating and under-investing for many years. We find that a key piece of our portfolio now. That's going to differentiate us at the same time. When you think about whether this is the new normal, the Fed is still operating to a dual mandate Fed. That's labor and inflation. And I used to talk about for many years a Fed that was taking into account a third leg of the stool, if you will, that third leg being the wealth effect, your 401k, your house price, all those things that contributed to your purchasing power. 70% of our GDP is consumption. That is fallen away a little bit with Chairman Powell, who has very much keyed in and said he is not going to be known as the inflationary Fed governor. He's going to be an inflation fighter. Paul Volcker, he harked back to at one of his recent conferences. That was a big signal to the environment in and of itself that the wealth effect is not as important. The Fed is not as concerned that we have seen a downtrend in equity markets. It is happier to see when inflation is coming down, and if it has to push on unemployment to make that happen further, it will. Over a long term, over a secular cycle, is that a major change for the Fed? No. We're still in a dual mandate Fed. We'll see who the next chairmanship is. But it's really clear, at least with this Fed governor, that if anything is changing, it's not a secular, but it is this Fed governor. The wealth effect is not the third leg of the stool anymore. It's just a two-legged stool.
All right, we'll go around on this one. You all have described a future that looks slightly different than the past. Can you each share something that the market might be missing right now?
Well, I think we've just come off a period of abnormally high S&P 500 returns. The decade before, the last trailing 11 years has been an unbelievably strong decade, which tends to suggest lower returns going forward. I would agree with that. So I think the market is anticipating that to some degree. We talked about the recession. People were overly fearful now, and that's affecting asset prices. I think in my case, many people are unwilling or have been unwilling to invest in traditional fossil fuels. That's led to underinvestment, and the outcome in many cases is abnormally high returns after a period of underinvestment in a very cyclical energy industry. And we can see that around the globe now, that many other countries, Germany, et cetera, have underinvested in traditional pipelines, and now they're caught short natural gas with the Russian invasion in Ukraine. So I think it's a good lesson that wherever capital is scarce is a good place to invest, because you might get a higher rate of return, whereas if it's plentiful, i.e. technology, lots of money coming in over a decade or two, perhaps the returns might be lower going forward.
Rick, do you want to add any areas that the market might not be seeing right now?
I think there are two areas that maybe it's not that the market isn't seeing it, but it's not placing enough weight on it. And I'm not predicting, I'm observing here. Number one is, I think although a lot of people are bearish and think the market's going down, they think, well, it'll go down, we'll go down short, shallow, even deeper, and we're back to the races. If you've lived through bear markets, they're devastating. The 1973-74 bear market was down 50%. The market went down 50%, the Dow Jones Industrials. brokerage houses, very similar to the financial crisis, changed hands. Some went under. I think it was Sally Quinn in the Washington Post that said the brokerage community changing things is like rearranging the deck chairs on the Titanic. That's what she said in 1973, 50% decline. The dot-com bubble, the NASDAQ went down 80%, that's 80. And when you go down 80%, you have to quadruple your money to get even. And eventually, of course, technology got even. It took 15 years for the NASDAQ to get even. For those of us who are older, retired, need our money, 15 years is a long time to recoup your money. The financial crisis, 1973, wiped out all gains since 1995. And Paulson of Goldman Sachs, who was the Treasury Secretary at the time, wrote a book called On the Brink. And he said, had the government not intervened or come in, we would have had a depression like 1929. Which brings me to my second point. So I think people don't realize how bad market declines can be and bear markets. The other thing is, the number two thing, is that I don't believe, although we may have priced in the market right now, short-term recessionary problems, I've never seen more potential problems in my life. Global debt is a bubble. It's going zero interest rates for 10 years is going to be serviced now by inflation. Inflation is picking up by higher rates. And yes, it's going in the right direction, interest rates and inflation. Britain is down from 10 to 9. We're down from, 8% to 5%. That's still horrible. Have you been to the grocery store lately? This is expectation. So I think people have not priced in yet the risks of global debt, inflation. Number three, I would say, harken back to what Hank Paulson said, if the government didn't do something during the financial crisis, we would have been on the brink of a recession. Are we in a better place now politically for the government to get together? We can't even they're trying to do the debt ceiling now. Imagine if something happened and the government has to get together we're in a worse position now politically. So I think, quite frankly, there are huge risks in the next decade that are not priced in to the market right now. So let me say this about our strategy. If there's only a 5 or 10% chance of a 1929 or a financial crisis or a dot-com bubble, or you have a house, what are the odds of your house catching fire tonight or a burglar coming in? Very low, but you still have insurance. Not to allocate to a strategy, in my opinion, that can weather storms, and I'm talking about Westwood, not only Broadmark, but the strategies, multi-strat, energy, that can manage risks, is foolhardy. So I think every investor should have a 10% position in strategies that can weather strategies that can weather storms and have the history to prove it. So I'm not predicting, I'm just observing that there may be risks out there that we don't know about, and it seems to me a sensible thing to allocate to those strategies a little bit of money, 10%, maybe more, that can weather those storms.
Thank you. And Adrian?
Well, I'll call two things. The kind of boring thing is fixed income is more attractive now. Fixed income is more attractive because rates are higher. And just a quick metric in thinking about this, Greg talked about that 13 years prior to 2022, the average S&P 500 return was 16.5%. We're likely not going back there. It'd be nice, but if we hit a proverbial 8 to 12% S&P 500 return environment, guess what? Cash yields are 4+%. You add a little bit on top of that for corporate bond return, and it gets you to a pretty healthy 6%, or maybe on an investment grade bond portfolio. If you just think about the asymmetry that goes with that, of if rates rise, which is bad for corporate bonds, and spreads go wider, they become riskier, by a little bit, you lose some money. And if the opposite happens, you make some money. Rates go down, they become more attractive, and spreads drop, they become more attractive. There's asymmetry in return. That ratio of the upside versus the downside, what happens when those two things happen, is now about 3.5 times. You make 3.5 times more on the upside than you do on the downside when those changes happen than you did at the end of 2021. Investors are rewarded in their portfolio for asymmetry of holding more corporate bond exposure and finding those opportunities. That doesn't mean you should have all there, but it means that investors in the next several years, I think that's going to be a dynamic. They're going to want more fixed income exposure. Next thing is, let's not forget that we just came out of COVID. We sat at home and we worked. We were ordering online for food. We were ordering online for everything, actually. These are huge dynamics that have created cultural change, that have created true secular change. And so thinking about thematics, that all this has led into inflation in other areas. Some thematics that we're thinking about are mRNA vaccines. The biggest one we know of course, is what happened with, starting with Moderna. But these are vaccines that helped us get through COVID with the vaccines. They have applicability across bloodborne diseases, across cancers, across other areas, or at least that's what they're investigating. This has a potential for a much larger thematic to happen. So that's something that is a thematic that we're looking at. We look at other thematics like clean energy, where because of the inflation we've seen, of course, we've got the misnamed Inflation Reduction Act, which is $400 billion of investment over the next multi-decades into clean energy type of technologies. That potential investment, that government-led investment as well, is not something you fight. That's something you can embrace. That's a thematic that's a longer-term thematic that investors might want some exposure to. So we look at areas like that. Obviously, there's the consumption change of stylistic consumption and what might happen there. But investors should think about some of the transitions that have truly happened, that it wasn't just that couple of years that we were all sitting at home. These are adaptations that are secular changes to the environment that may lead to opportunities in investment.
Well, Adrian, Rick, Greg, thank you so much for joining us and sharing your insights today.
Thank you for having us.
Thank you.
And to our viewers, thank you for watching. For Asset TV, I'm Jonathan Forsgren. We'll see you next time.